Hello, my name is Josh, and this is my quick thoughts on Netflix. Today, we'll be discussing the #1 streaming service, Netflix. I'm sure you all know, and we'll be looking at it through my three-pronged framework. So again, it goes product, macro environment, and valuation. So let's actually start with valuation. So last video, I showcased a bit of how I look at the valuation of a company. And I sometimes use a DCF, so we have that over here. But oftentimes I use just a quick gut check. I look at this, and this tells me if I want to do a deeper dive or if I deeply understand the company and I kind of want to just say, right, what's my valuation? This is what I use. So how it works is you type in the revenue. So I use this site, Macro Trends. So I have here what the revenue was last year, 27. It also helps me understand what's a realistic growth rate, so we can understand when 35, 27, 24, 21. You can see growth rate is slowing, and actually for the last quarter it was 19% year over year, but it's still relatively high, and it's not dropping too quickly. And market cap, which you can also get either from Google or there. And then we look at margins and growth over the next 10 years. And when we look at margins here, we can see that their gross margin, so again, this is how this would include the cost to produce the actual the shows. So it's 40%-ish. It's obviously been as low as 25, but it's typically been about 35, I would say. Actually, it's going up. So you could say there's some economies of scale here. And operating profit, which is after taking into account all the expenses. So that's marketing, what we call SG&A, sales, general and administrative. There's other expenses, but you can see that's significantly going up lately. And this often happens with businesses with high fixed costs. Because what happens is, so for Netflix, my apologies, let's say they spend $16 billion to produce shows. If you only have 100 million subscribers, that's $16 billion is going to spread only over 100 million subscribers. But if you get 5 times more subscribers and you have 500 million subscribers, maybe you spend a little bit more on content, but for the most part, that your content is spread out over more people, so your cost per user is lower. So that's an idea of you want high fixed costs, because once you get to scale, you can really start seeing what we call operating leverage. So same with leverage, like as you get bigger and bigger and bigger, you can really see this operating margin go up, 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 up. So they're starting to do that. And there actually was an interesting one from Scott Galloway. He did how often they mentioned growth versus margins in their earnings call, and they've significantly shifted lately. So they're mentioning margins much more because they are getting that operating margin and their growth is slowing. So they're trying to signal to the market, hey, don't expect 30% growth anymore, but we will start becoming much more profitable. And you can see for the longest time they were barely making a profit, and lately they've actually been doing very well. So net margins after taking into account taxes. And actually, if we look at profit here, how much operating, let's go net income they made. So they made $4 billion in profit. And you can see that's 4 times what it was a couple years ago. So again, if we're looking at revenue is not 4 times. It was 15 billion and now it's 27 billion. So it's not even doubled. But their income has more than quadrupled. So that's operating leverage at work, is each additional dollar of revenue has a really huge increase on your profits. Maybe not your revenues, but your profits. So that's a bit about the business model of Netflix. But let's look at what I think kind of the margins could be. And again, here I have a DCF. So I said how many customers, what's the growth rate, revenue per customer. And right now, because in some countries there's much lower, much higher, yada, yada, yada. Let's just go with the gut check for now. So I personally think that you saw that they're slowing growth, but that's slowing growth of users. I actually think they'll also see a bit of a benefit in revenue per customer. I think that this is becoming a very sticky product. I know I would never shut off Netflix. I love it. So if they increase prices by $1, I think I would keep it for sure. And so if you have 200 million users and you add $1 to each user, let's say it's $15 a month now. what's 1 over 15? You just increased it 6.5% without adding any subscribers. So I think they could do that every couple of years, add $1, maybe even every 2 years, $2 every 2 years, whatever it is, and not see much loss in terms of subscribers. So I think they could really have pricing power, which will help their growth in terms of revenue. But I do think the actual number of users is going to be 15. I think would be optimistic. I think 10 to 15% is realistic. Let's actually put one in here, 12.5%, which I think is maybe more realistic. I think over the next 10 years, because I think it will be 20, then slowly 17, then 15, then 12. So I think there's also the optimistic side, which I'll get onto with tailwinds. But yeah, this is kind of the framework here. So now we have kind of an idea. So let's go over the product again. So Netflix, everyone knows, the world's largest streaming service, accounts for about 50% of paid video streams. And at one point, I think it said it took up 30% of the bandwidth of the entire internet. It was some crazy thing like that. Yeah, it's a lot. I love Netflix. I love the shows. The stock's been rallying lately. It's up about 25%, I think, ever since the last little bit. Squid Game was a huge hit, and also they had some production delays during COVID. Now they have a huge slate of shows and stuff coming out, so they think that'll really benefit. And they did also beat expectations in terms of subscribers. So they were expecting, I think, 3.8 million, and they got 4.4 in the last quarter. So the stock's really done well lately. So I want to reevaluate. Do I still want to hold it? Do I still believe in it? Or is it something where I think is now fairly valued? So product's amazing. I love it. Someone at work said, "Oh, I hate their UI." So I said, "Okay, do you like Amazon Prime?" "No." "Do you like this?" Anyway, he hates all the UIs, but he said Netflix has the least best UI. So, I'd love to see some improvements to the interface, but I do love the algorithm. I think the algorithm is amazing. I think it does a great job of recommending shows. And I think that is going to become a bigger and bigger part, because that is really the beauty of the internet, is there's so much great content out there, but it's great content for me. You might hate it, but it recommends shows that it knows I would like. Just like YouTube, I'm a huge YouTube fan, and I'm sure one day I'll talk about Google, but I see content that I like. So I'm a huge fan of of the product, and I think they make great shows. And also a benefit they have is they have such great intelligence and data on what people are watching that they can then create better shows for cheaper. So they know what kind of shows are popular, and they can see these signals early. So I'm a big believer in the product. So that gets a big check. So then let's talk about tailwinds. So obviously a huge tailwind that's been helping them for the last little bit is people cutting the cord cutting. I have never had cable. I had it when I lived at my parents', but I personally have never had a cable subscription, because to me it's crazy. The average subscription is over $100 a month. Netflix is $15, and I share it with my family. So there's three households in my family that share it. So you're talking $5 a month. This is the steal of the century. I think it's got better content, and for a 20th the price. So I think it can't be beat. And again, young people are cutting the cable, or never even getting in the first place, and older people they're either dying or they're cutting the cable as well. My parents have discussed it, and I know some other people have too. Some other friends' parents who are saying, "You know what, I've had it, enough with the cable. I'm not seeing much value. I'm spending more time on Netflix." My grandparents love Netflix. They still have cable, but they love Netflix. So I think demographics for younger is definitely helping them, the youth. And also geographically, obviously they started in the US, but they actually have a huge international growth. And I think it was something like they see India could one day be 100 million subscribers. And there they have actually a mobile-only plan. It's much cheaper, but people can watch just on their phones, because there they don't have it's not as common to have a big home entertainment system like we have here with big TVs, but a lot of people watch just streaming on their phones. So they have a mobile-only one. And they are creating lots of international content. So I don't know if you've seen Lupin. It's a French show. I loved it. Squid Game, again, Korean, South Korean, I should specify. But there's a lot of great content. We watched Dark, which was German. There's so much great content that they're creating all around the world globally to attract global users. And I think that's going to be huge as more and more of the developed world comes online and their disposable income grows. I think Netflix could be a huge beneficiary there, because here you're fighting. It is a benefit that people are cord cutting, but they never even had cable to begin with. So you're going to be competing against nothing, which is always a benefit. No, I mean, you could be competing against something free like YouTube, but I think that Netflix has huge demographic trends and tailwinds behind them there. Now there is competition. Lots of people are getting into streaming, and they obviously revolutionized and started this whole streaming game. But now everyone's coming for them. So there is competition, though I don't think it's exclusive. I don't think you're going to have only Netflix or only Disney. I think a lot of people have multiple ones. But let's look at what I think about their revenue growth and margin. So as discussed, I try to be a little conservative, but I also want to be realistic. I don't want to discount someone too much. So recently it was, where are their margins here? Oops. Margins, sorry for all the clicking around. Their margins were 22% last quarter. And again, I continue to see that long-term going up. So, I think long-term, it's realistic to have margins around 25%. I think it could even be higher as they get operating leverage, but let's say it's 25%. Again, I want to be a little conservative. So if they're growing at 12.5%, which is what I said, I could see it being high. Again, I want to be conservative. I think they could grow maybe 12.5% subscriber base over the next 10 years, maybe even 10%. But I do think with the pricing power they have, I think revenue growth will be even higher than that. So if you have 25% with 12.5% growth, again, trying to be conservative, you're about 7%, which is, again, it's about what the market does. And if I'm saying, hey, I can get market-ish returns while being really conservative, not really conservative, but relatively conservative on a company, I think that is it passes the sniff test. And that's then when I'll go do the DCF and say, let me look at this further. What are the risks? What are the upsides? They're getting into gaming. There's some optionality there. Maybe merchandising. Some people say right now they're only streaming. They need to make money elsewhere. Like, I think it was Star Wars that said they made $5 billion just on merchandise of selling Star Wars. Like, they have IP now, Netflix, valuable IP. Could they create an amusement park? Could they start selling more merchandise, video games, all that stuff? I definitely think so. I see a lot of optionality beyond the streaming service. So again, this is what I look for. I look for looking at a conservative downside case, not downside. Again, downside could be, the world ends, not to be too bleak, but, there's obviously downside, but I try to say realistically, what is a conservative estimate of what this business could look like, and then say, great, now I have upside potential. So again, maybe it ends up with 35% margins and 15%, or maybe even 17.5% because they also get into merchandising, and then I get 15% compound annual returns, which is, again, my goal is to get 12.5% returns, which is beating the market heavily, in a nice way. Again, the market on average returns about 7%, so that would make me happy. So I still like Netflix. I sometimes go in and out. Some days I'm feeling low on it and pessimistic, and other days I'm feeling good about it. But lately I've been feeling good. I've been watching Squid Games, big fan, and I see only more great content coming out. So, and again, the big thing for me is that pricing power. I really think they're going to have pricing power, which is really going to help their growth, because I do see subscriber slowing down. Though again, there is the fact that there are developed nations that are, they said India could be a huge subscriber base for them. So we'll see. But right now, full disclosure, I do own Netflix shares. I am a fan. I love the business. And I also do think it's fairly valued, maybe even a little undervalued. Again, it's been rallying lately. I was buying earlier when it was a little low about a month ago. It's obviously gone up about 20% since then. So now I don't think I'll be buying any more right now, but I like the company. So my name's been Josh Lipton, and these were some of my quick thoughts on Netflix.